Markets love known risks, but the Fed just turned a trade truce into another unknown. With the government still shut down and private data in the driver's seat, every ADP and ISM print now matters like never before. The next few miles may be uphill, but that's where the real investors separate from the crowd. Yesterday, the New York Marathoners hit the finish line, and this morning, Washington is chasing its own personal best in dysfunction. Day 34 of the government shutdown, one day shy of the 2019 record. You could call that a personal worst or a new American record, depending on your level of sarcasm. The markets, well, they're stretching and breathing and holding form just below all-time highs after a week that tested everyone's endurance. Last week's trade truce between Presidents Trump and Xi brought a bit of relief, like water at mile 20. China agreed to reopen the spigot on rare earth minerals. The U.S. halved fentanyl tariffs, cut some others by 10 points, and China agreed to resume buying U.S. farm goods. Call it a temporary peace. Markets love when unknown risks move into the known column, even if they're only partially known. And then there's the Fed, our reluctant pacer in this marathon. Powell and company did exactly what everyone expected, a 25 basis point rate cut and the end of QT, and, of course, a hawkish wrapper to go with it. Powell tried to cool the crowd with his no guarantees speech about December cuts. Thank you, Captain Obvious. When has there ever been a guarantee in markets or in life, and certainly with the Fed? He made clear that not everyone in the room is eager to keep cutting. And apparently the Fed still believes that unemployment is low, even though it admits that the recent developments might be a bit troubling. Classic Fed, stating the obvious and leaving everyone even more confused. Futures now give about a 67% chance of another cut in December, but Treasury yields jumped anyway because, well, markets don't like uncertainty. Congrats, Mr. Powell. You managed to move one risk out of the known column and right back into the unknown. By Friday, 3 FOMC members, all with strong opinions and hawkish cred, took to the mic to oppose more cuts. 2 of them can't even vote until 2026, but hey, they got their headlines. Still, the message was clear. There's a growing pushback inside the Fed. That's why Powell's tone was darker than expected. And we'll get some more color on November 19th when the minutes actually drop. But until then, the data will drive everything. And the data, in case you haven't noticed, has been, well, let's say, a bit sparse lately. Home prices continue to climb, and that's inflationary. Consumer confidence beat expectation, but it's still falling. That's like running a strong split on dead legs. That's not terrible, but that's not great either. And you know my mantra? Confident consumers consume. Without them, the economy loses its rhythm. Earnings, however, gave us something to celebrate. 5 of the Magnificent 7 reported last week, along with a truckload of S&P companies. And so far, the S&P has beat EPS estimates by 2.35% and revenue by nearly 5%. That's pretty strong. Even stronger, EPS growth, well, up 11% year over year versus consensus expectations of around 8%. Tech leads that pack, and communication, unfortunately at this point, lags. In other words, the market's favorite children are still performing, and their annoying cousins, well, they're still whining. Now, looking ahead, the road gets a little steeper. With the government still closed, the calendar thins out a bit, but the data that remains carries extra weight. The ADP private payroll report, which was once a nice-to-have cross-check, well, it just became a critical mile marker. We've had 2 straight months of declines. If that continues, the Fed will be under pressure to reassess its hawkish posture. If it bounces back, well, Powell's tough talk will get more credibility. The ISM surveys will also be crucial. They're corporate mood rings with teeth. Manufacturing shows us new orders and inventory. Services show where jobs and demand really live. Don't just watch the headline numbers, though. The sub-indices are the story of the day. New orders, backlogs, supplier deliveries, prices paid. Those tell us if tariffs are still biting and whether supply chains are healing or hurting. Most important, employment components. If confident consumers consume, well, then confident companies they employ. That's the cycle we need to see. With the government data blacked out, these private surveys gain extra power. Fewer signals mean each one hits harder, which translates to bigger market reactions. Expect volatility around ADP and ISM, like hitting an uneven patch of pavement mid-race. Later in the week, the University of Michigan sentiment report takes center stage. It arrives on time, even when Washington doesn't. Sentiment is not cash in a wallet, it's the willingness to use that cash. In a year of politics, tariffs, and sticky prices, well, willingness, it matters. Watch the expectations component and inflation expectations closely. That's the Fed's real heart monitor. Earnings continue too, but this week is about read-throughs. Cloud-adjacent software companies will show whether the AI spending boom is filtering down or still trapped at the top. Semiconductors, well, they need to prove that inventory normalization is real, not just a talking point. Consumer discretionary names will test whether rate cuts and wage gains can offset price fatigue. And healthcare will tell us about procedures, utilization, and real economy strength. Energy will add color on trade flows and cost structures. Useful backdrop to that Trump sheet truce. And pay close attention to guidance because beats aren't everything. The market is punishing companies that hint at slowing operating leverage or higher CapEx. We know all about that. You'll hear words like disciplined, calibrated, and flexible, which translate to we're ready to cut spending if things turn. Again, confident companies, they employ. Too much caution in earnings calls, and you'll see it in payrolls next. In the background, rate expectations are still running the show, my friends. Futures priced in a decent chance of a December cut, then backed off as the hawks flew out last week. That tug of war will dominate the week. Watch front-end yields on ADP day and term premiums around Wednesday's refunding. Even without government data, the plumbing, it still talks. Credit spreads are the quiet signal. If they stay calm, equities can keep climbing even though Powell talks tough. If they start to leak, well, you better watch out. The trade truce didn't erase all risk. It just repriced it. Rare earth relief, it helps manufacturers, but tariffs are still high. Executives will still talk about nearshoring and localization as risk management, not as cost savings. The supply chain is still a work in progress. Consumer behavior continues to split. Travel and dining are strong. Big ticket durables are weak. If Michigan sentiment holds up, services will stay healthy. If it slips, well, expect value to be the new buzzword on earnings call. And don't ignore the labor story. Whether firms are freezing hiring or still scrambling for talent will reveal just how confident management really is. For investors, that's your playbook. Don't confuse a temporary flat stretch with a permanent downhill. Trim where position size ran ahead of conviction, and add where execution outran narrative. Focus on earnings power, not one-day reactions. Personal bests, well, they don't happen because the course is easy. They happen because you stay present through the hard parts. We're not at the finish line, not even close. The next few miles are uphill, but that's where the real runners separate from the crowd. Consistency beats bursts. Confident consumers consume. Confident companies employ. And confident investors, they stick to the plan, even when the route ahead looks uncomfortable. So your truth bomb for today is this. The market's personal bests don't come from easy miles. They come from staying in the race when everyone else is winded. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.